Welcome to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about LG Display is that it trades at a price to book value of 0.5, less than half the Korean average. This is Andrew Stotts of the Valuation Master Class. Let's get started. Remember, this is for information purposes only, and it's not investment advice or recommendation. So LG Display is in the infotech sector in Korea, and it's among the world's largest manufacturers of displays for TVs, mobile phones, and computers, with a market share of 21%. There's three things to know about this company. First, intensified price competition leads to a loss of market share. Second, end markets for displays face maturity, expect low growth. And third, focus on premium products to turn around the margin. Some of the key statistics. First, there's 32 analysts covering this company, and they've got a 32% upside, meaning a buy. The PE of the company is just 5 times. That's crazy low. And the dividend yield is 0. Not unusual coming out of a crisis. My estimate of value is 21,067 Korean won, which is an upside of 7%. So I'm less optimistic. Hold. In fact, I've done research looking at the optimism of markets across the region, and I've found that Korea is the market where the analysts are the most optimistic in their forecasts and target price. In fact, my PhD dissertation was on that topic. So welcome to everybody attending. Welcome, Hillary and others. Let's look at the revenue breakdown of this company. So IT products are 42%, mobile products 30%, and televisions 28% of revenue. 63% of revenue comes from China, 17% Europe, Asia 9%, US 8%, and Korea only 3%. This truly is a global company that's generating income globally. Now, the price recently turned bullish, but low volume support. In fact, I'm looking at the share price right now, and it's kind of range bound between 18,000 and 26,000. And in early 2022, the 50-day moving average has crossed the 200-day moving average, which is a positive signal. However, the share price seems to cross the 50-day moving average soon, which could mean a turnaround in the trend. Volume RSI has been strong in fourth quarter, and recently it moved to 50% line, providing no clear signal. So looking at this, we have a little bit of a breakout on the price, particularly for the 50-day moving average. But I would say that share price chart doesn't make me that excited. Now, what's the story, you might ask? So story number one is intensified price competition leads to loss of market share. The chart I'm showing is LG's global market share for large size display. And the peak of that market share was 2016, 2017, 2018, when it was 29%. And that's gone down to 19% as of 2021. The display industry is dominated by Asian manufacturers from China, Taiwan, Korea, and Japan. So it's intense competition. And also, Chinese companies aggressively expanded their capacity to produce displays at lower prices. And the Chinese government continues to subsidize its domestic companies, which could even lead to a potential oversupply soon. Now, hold on. So, supply shortages are driving up selling prices, but only temporarily. A chart that I'm looking at right now is looking at the millions of glass sheets of display and the price per square meter of display. In 2019, the average selling price for LG's displays per square meter dropped by 17% compared to 2015. It's mainly to keep up with cheaper products from its competitors. During the pandemic, the price for displays spiked in response to excessive demand and supply shortages. I believe this trend to be short-lived and expect falling prices again soon. Now, story number two is end markets for displays face maturity, and I expect low growth. So again, I'm showing another chart here which looks at global smartphones sold and global TV units sold. LG Display's revenue is mainly dependent on the growth of its end markets, such as computers, phones, and TVs. A mature market for smartphones, translates into low demand for displays. The same goes for TV, which saw declining trends over the past years. Now, the end market for display is facing maturity, so expecting low growth. Let's look at the revenue here. My revenue forecast is versus consensus. In the past, LG Display has been in a downward spiral. Between 2015 and 2020, revenue declined by more than 15%. So now we can see some of the reason why the company may be trading at a low price to book value. Maybe investors don't trust them. Now, despite a jump in 2021 revenue, the company faces a challenge to hit the 30 trillion Korean won revenue mark over time. Analysts are relatively positive on it, but I expect declining revenues in the following 2 years. Now, the focus on premium products to turn around margins is happening. We can see in this chart that I'm showing is the EBIT margin of 4 competitors: LG Display, BOE, Samsung Display, in Innolux. There's 2 that had a negative margin in 2019. That's before the 2020 global economy shutdown. The 2 are LG Display and Innolux, and both of them in 2020 came back to just being break even. Currently, there are 2 major technologies prevailing in the display market. The first one, LCD, existed since the early 2000s. Chinese competitors started to compete on price for LCD TVs, leading to a severe drop in selling price. The other TV tech, OLED, is supposed to deliver a better picture quality, but is more expensive. Now, the focus on premium products to turn around the margin, let's just look at LG's display EBIT margin. LG's has realigned its strategy to transition to high margin OLED rather than responding to the price competition of LCD TVs. Currently, only Samsung has emerged as a serious competitor in OLEDs. And this means that OLED TVs can maintain a price premium for some time. This strategy should help stabilize LG's margins and turn around losses. Now, remember, you can scan the QR code if you're watching the video to go to the Valuation Master Class blog to download all free case studies. Now, you can also click the link below and get access to it. Let's review the company's FVMR scorecard. It measures the stock's attractiveness relative to all other companies, and attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. The scale is from 1, best, to 10, worst. Here we can see it's kind of middle of the road. Valuation looks super, super cheap. And let's look at momentum for a little bit. Here we can see that revenue growth in the past 12 months has been up 23% and recurring EPS growth 300%. And so basically there's a turnaround happening in the core business. And that's part of why we see some possible momentum in the share price. Now, recently I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan that QR code or just go down below. Now, the forecasts. Consensus sees a cheap opportunity to buy. There's 32 analysts. They have an upside of 32%. And most analysts have issued buy recommendations, while 5 analysts recommend a sell. And consensus expects a strong revenue boost in 2021, but flat revenue after that. So consensus is expecting 21% revenue growth in 2021 and then about flat for the next couple of years. They expect the company to turn around its losses and achieve a higher level of net margin. Now, profit and loss, the company is likely to benefit from supply shortages and excessive demand. So we think that profit will now turn from negative, about 2 trillion Korean won, almost 3 trillion, now to be positive about 1.4 trillion. And the average display selling price per square meter has reached its highest level ever, which can support that. Now, I consider this effect only temporary. Let's look at the asset side of the balance sheet. Contrary to its Chinese competitors, I don't expect LG Display to pursue an aggressive expansion plan. So I'll just keep net fixed asset growth stable in line. Now, looking at the liabilities of the balance sheet, the company started to reduce its long-term debt in 2021. And also looking at ratios, the company is characterized by rather weak efficiency, where this means that the company needs to increase investment to drive revenue growth. Right now, they're generating about 70 in won for every 100 won in assets. Now, let's look at ratios further and look at gross profit margin. With increased focus on producing higher margin displays to escape the price competition on LCD TVs, I expect the company to maintain a higher margin over time. However, the competitive advantage is likely to diminish over time, which is also incorporated in my forecast, which is why I tend to be a little bit more negative than consensus. Let's look at the valuation of the company. Before we do that, let's try to identify whether this could be a 10-bagger or not. This scorecard or checklist, stock picking checklist that I have created with my team is inspired by Peter Lynch's book, 10 Baggers, a stock that has gone up by 10 times. And the scorecard is based upon our extensive research of 10 baggers. And there's 9 factors that drive long-term share price performance. What we're going to try to do is say at the end of this list, can this company be a 10-bagger? So first, management. Management has a proven commitment to growth. Weak. In the past, management has reduced production capacity, leading to declining revenues. Number 2, product and industry can support a decade of 10+% annual growth. Weak. The end market for displays is mature and smartphones and other things. So it is a bit of a tough situation there. Number 3, sustainable. Competitive strategy creates sustainably higher gross profit margin. Weak. Competition in Asia is intense, and the Chinese government also supports domestic companies. The point is, this is a commodity business. It's tough. Quality. Number 4, quality, good earnings quality, non-core items are small or non-existent. Weak. High fluctuations. EBIT has been negative in the past 2 years. Number 5, efficiency. In the long run, sales growth faster than assets. Weak. The company is characterized by a low efficiency. Asset turnover is less than 100%. Number 6, tight, relatively low cash conversion cycle. Negative is best. Moderate. Cash conversion cycle is moderately high and stood at about 25 days in 2020. That's not terrible, but it's not like it's super, super awesome. Number 7, cash flow. Operating cash flow is consistently positive. Moderate. Operating cash flows fluctuated a lot, and sometimes it wasn't enough to cover investing outflows. 8, capacity. The company has access to capital to fund growth. Moderate. The company is relatively highly leveraged. Net debt to equity stood at about 0.9 times in 2020. And finally, number 9, inexpensive. The valuation is reasonable, and we want to avoid very expensive stocks. This is where the only place on the scorecard where it's good. The massive discount on both PE and price to book compared to Korean Infotech, but low ROE. So what's your conclusion? My conclusion by looking at this is not going to be a 10-bagger. It doesn't mean that it couldn't go up. It doesn't mean that it couldn't be attractive at this point, but I would say it's not going to be a 10-bagger. Now, free cash flow, we can see, was dragged down by massive changes in net working capital in 2021. And so it should in 2022 return to a relatively strong level. So I expect a lower revenue growth than consensus, as I assume that the temporary price-driven revenue boost to not last much longer. And the quantity sold has been on a declining trend before the pandemic and might continue going forward. I use a reasonable 2% terminal growth rate, and valuing it on a free cash flow methodology, I have a cost of equity of 12.6. So that comes up with the base case of a 7% upside, the bull case of 18% upside, and the downside, which is 4%. So let's look at the world-class benchmarking scorecard. But before we do, I see I've got a question coming in from Rachanan. How does LG's display differentiate its product from other competitors? I think that you nailed it with that question. Part of the problem that they're facing and the reason why they can't sustainably maintain a high level of profitabilities because it's very hard to differentiate in such a commodity business. Now, let's look at it in a little bit more detail to see if they can build a competitive advantage. In the world-class benchmarking scorecard, we identify a company's competitive position relative to global peers. So Rach and I, we're going to see if they are even maintaining that position. We use a composite rank of profitability and growth called profitable growth, and we scale from 1 best to 10 worst. Here we can see that the company in 2018, 2019, and 2020 has been the worst in the world relative to 700 large infotech companies worldwide. The good news is that the performance moved to average, and that average performance came in the past 12 months. What is driving that average performance? Well, there's been a slight increase in profitability. Profitability in this case is ROA, and for the past 12 months, it's ranked as a 7. So it's still below average, but it's not as bad as 10, which is where it was. And then growth in EPS is very strong at a 2 in 2020 and a 1 in the past 12 months. And as a result, we get some push up in the profitable growth score. So I would say an average performance here. What are the risks? Well, the key risk is intensified price competition. Failure to keep up with latest technology to maintain a competitive advantage is a big risk. High concentration of key customers and fluctuations in demand as end markets are sensitive to market conditions. So, the conclusions. Markets for displays is mature. Expect flat or declining revenue. And the focus on OLED technology could bring sustainable higher margins. The valuation cheap, but probably for good reasons. So, my question to you, is LG Display a deep value play or cheap for a reason? Let me know down below with your comments. Have a great